Hello again, everyone. It's Vince Vora from TradingWinds.com. And in today's video, I want to talk to you about trading in 2023. Should be a very interesting year and what I would expect to be a very volatile year. So when it comes to using a particular strategy in 2023, you can use just about everything, but understand that compared to a very clean, sustained trend like we had here from 2020 into 2022, it is much different trading during a period like that compared to what we saw most of last year, 2022 here, and now heading into 2023. Just look at the difference in the bars here, the price bars. Very orderly here on the way up, very similar in size most of the time. And then we get to this section here in 2022. And throughout the year, you can see that the bars are much bigger in range from low to high, right? And there's a lot more chop, a lot more back and forth, right? So you have to trade this environment a little different than this environment. When you're trading with technicals and you have a sustained trend like this, it actually makes trading with technical analysis very easy. Things are very predictable. You don't get stopped out a lot because the fluctuations are minimal. But during a period like this, getting stopped out happens very frequently. You need to change the way you trade. And what I would suggest you do in a period like this is be much quicker on both the entries and the exits. And I expect this to continue throughout 2023. So that's what I want to talk to you about now. I'm going to give you several tips that you can use to trade a market like this. But really what you want to do is be quicker, both to enter and to exit your trade. And I'm not talking about day trading necessarily. Sure, if you're used to that, it's going to be the same thing, whether you're trading on a 1 minute, 3 minute, 5 minute, 15-minute chart, whatever it is, you're used to getting in and out quicker. But if you're more of a swing trader, more of an investor, that is much different. And so even as a swing trader, when you're in a position for a couple of weeks to a couple of months, you want to be in and out a little more frequently to minimize the chances of you getting stopped out and taking losses. So how do we do that? What strategy would be an effective one in an environment like this? You can use, several strategies. We here at Trading Winds prefer my victory strategy, which, obviously keeps you in a sustained trend. It tells you when to get in during a trend, when to get out, and it's pretty quick to respond. But a very, very simple, I'm going to give you something that's very simple to follow all the time, no matter what, but is even more effective, and I'm going to tell you exactly how to trade it more effectively in an environment like the one I expect to see in 2023. So all I want you to do is put a simple moving average on your chart. And that is here, this line in blue, which is the 20-period simple moving average. You can use exponential if you want. You can use weighted. It really doesn't make a huge difference, but I prefer just the basic 20-period simple moving average. And you can use this whether you're trading on a 1 minute chart, a 5 minute. I'm going to use Crocs as an example here. All right. A 1 hour chart, daily chart, weekly chart, monthly chart, whatever you want, you can use the same moving average across. And the 20, I find, is a very, very effective moving average, mainly because it is so widely used by most retail and professional traders. Now, the only time frame that I would maybe shorten that moving average is on the monthly. I'd probably tighten it up to a 10-period moving average. Reason being, when you get a sustained move on a monthly like that, you want to keep the bulk of your profits after a move like that. So the higher the moving average, the longer it's going to take for price to come back to that moving average and have you switch directions, right? So you're going to give up a good portion. If you put on a 10 period, it'll hug price a lot closer and get you out closer to that top. But on other time frames, be it weekly, daily, or any of the intraday time frames, a 20 period moving average is extremely effective, as you can see here, in keeping you on the right side of the market. In other words, there are periods where you get a chop and it hugs the moving average and will cross below and back above, below and back above, etc. There, and that in those periods you'll get stopped out. But most of the time, if price is above the moving average, it tends to move higher, and if price is below the moving average, it tends to move lower and back and forth, right? So it's quite smooth. So if you want to avoid the choppy periods where you tend to get stopped out more often, just look at the slope of the moving average. And the only time you really want to trade is when it's sloping in the direction of the trade. In other words, if it's flat, there really is no direction. So you sit on the sidelines and you wait, right? Now, in an area like here, you see how it crossed, but the moving average was sloping lower, okay? So if you're more of an aggressive trader, yes, you want to take that entry. If not, you just wait a little while until the moving average starts to slope in the direction of the candles here, of the price bars. So if price is above the moving average, you want that moving average to slope upward. If price is below the moving average, you want it to slope downward, okay? So right here, when it crossed below, okay, if you look at what the moving average was doing, it was moving higher, right? So we wait. We don't get in there. But as soon as the moving average starts to roll over, and usually when you switch directions, you get a bit of a bounce, kind of retest that area, and then continue to drop. So once you had here this candle here where you had a couple candles that went higher, and then you came back and you took out that prior low right there, where you had, not only did you have slope lower, you had a significant slope lower, right? And then you went with the trade from there. And then your exit is on a cross in the opposite direction of that moving average. It's really that simple. So a moving average like the 20 period moving average will keep you on the right side of the market most often. Again, if price is above the moving average, you want to be long. If it's below the moving average, you want to be short, okay? Or at least out of the market if you're not comfortable going short. Now, in periods like this where things are a little more volatile, how do you tighten things up? How do you make sure that you're in and out of the market a little more often or a little quicker than usual? Well, you tighten the moving average, or you use a combination of moving averages. In other words, let's say you were to take this trade and get in here. You go long based on the 20. What you then do is you add an 8 period moving average. And if you're going to use the 8, I would use the 8 exponential moving average. It hugs price a little closer. Okay. So once you get in on that trade, whether it's immediately when it crosses the 20 or once the 20 starts to slope, you then use an 8 period exponential moving average as your trailing stop. In other words, right? And you stay in the trade as long as price remains above the 8 period moving average. But if it closes below, just crossing intraday doesn't mean anything, but closing below that 8 period moving average, you want to get out. Okay. And sometimes you will get a close below and the very next day it'll go back above, right? Or in this case, the next week. Right. And so be it. If that happens, you're out. Then if it crosses back above and the 20 is still below the 8 and still sloping higher, you can get right back in. All right. Commissions are minimal these days. But by using an 8 period exponential moving average compared to the 20, when it does turn, it gets you out a little quicker, allowing you to keep more of the profits rather than waiting for a move all the way below the 20, right? So And that is one thing you can do. The other thing is tighten it even more, meaning let's take off the 8 and we put on a 5-period moving average, right? And let me show you the difference if I keep the 8 on. So the 8 is in orange, the 5 is in white. It just tightens it up a little more. Okay, now you might not see much of a difference on the weekly, on the daily time frame. Again, it's not a huge difference, but you will see differences along the way. Times where the 5 will get you out as where the 8 would not have. So it really, what it comes down to is, what is your risk tolerance level, right? If having a slight move against you does not make you that nervous, you're trading with a very small amount of money compared to your overall portfolio, so you're completely comfortable letting it go against you a little more, taking a bit more risk, then that's fine. You don't even have to add the 5 or the 8. But if you're a little more nervous about it, you want to minimize the amount of risk involved with giving back some profits, then once you're in that trade, throw on the 8 or throw on the 5 and go from there. The other thing you can do is use all 3 together in combination. In other words, what you want to see for a long trade is price above all 3 moving averages, but the condition here is that they are stacked appropriately, meaning the 5 EMA is above the 8 EMA and the 8 EMA is above the 20. And if all 3 are sloping higher, that is your best case scenario. So if you have a look here, when they're all, look at it from about this point where even the 20 started to slope higher, right? And price was above, right? All the way up to this point where, the 5 EMA kind of started to flatten out a little. So you look at that area, right? You can buy anywhere along there, you're going to make money, right? Same thing back up here, all the way down here. Those are your easiest areas to trade. Reason being is, for whatever reason, the trend is super strong in that area. There's either a ton of buying going on or a ton of selling going on. And you're just jumping on and riding that wave. And at the first sign of any trouble, you get out, right? So that's what I'm talking about as far as how you want to trade 2023 compared to 2020, 2021, etc. So a volatile environment versus a fairly stable environment. You want to be quicker on the draw. You want to, improve your odds of success in the market. And the way you do that is to stick to the safest areas to trade, the areas where the trend is the strongest and is the most likely to move in your direction. And how do you identify that? You identify it with these 3 moving averages, just making sure they're stacked accordingly. For a short trade, again, you want to look for slope. That is the best when all 3 are sloping, downward that is, right? But what you need to see, the conditions you need to see are that the price is below all 3 and then they are stacked accordingly. So you have the 5 closest to price, you have the 80 MA above the 5, and you have the 20 MA above the 8. That is your ideal condition, okay? So if you stick to that criteria alone for buys and sells, you should do very, very well. How do you want to trade this with options? I would suggest, if you're an options trader, 2 of the safest option strategies to use during a more volatile period are debit spreads, right? Where, for example, throughout here, you're buying a call spread and then you're selling you're buying a call and then you're selling another call with a higher strike against that to bring in some premium, reduce your cost basis. Yes, you are going to cap your upside, but you're also limiting your downside because, as you know, when you're long an option, you can only lose what you spend on that option, right? So say you're in this case here, you're buying a call option. let's look at back here, was around the $40 range. Let's say you were buying a 50-55 call spread, right? So you're buying a call for $50. You're selling a 55 strike against it. Let's say you're paying about $1.50 for that spread. It's a 5 wide from 50 to 55, which means you have upside potential of $3.50. So you're risking $1.50 to make $3.50, right? And so you want to set up that spread within range where hopefully throughout this trend, price will actually end up fully in the money, meaning above that 55 strike for you, okay? But again, if it goes against you, the second it closes below the 5 or the 8, you want to get out, okay? And even if there's some news or a big gap against you, the max you can lose is the $1.50 that you spend. Now, obviously, with options trade, for those of you more familiar with options, I don't have the time to go into it in this video, but for those of you that are more experienced in understanding the option Greeks and how those affect it, you know that they can greatly affect an option position. And during times where it's a lot more volatile and you get a lot more back and forth, the Greeks can really impact your position. So if you want to avoid the Greeks during a time like this, use deep in the money options. In other words, if you're going long, buy a deep in the money call, say about an 88 to 90 delta. Yes, it is going to be a lot more expensive, but it'll still be a lot less expensive than buying the shares themselves. But that option position will act just like the shares. In other words, pretty much a 1-for-1. If it goes up $1, you make $1. If it goes down $1, you make $1, more or less, right? So, but the main thing is that you avoid the impact of the Greeks. So if you get into an area like this and it's fluctuating for a few days, or a few weeks, the Greeks will not kill your option position. So those are two things to consider. But again, remember, let's just stick to basics here and remember the clean, easy strategy, identifying the safe areas to trade. And in here, it's hard to go wrong. Whether you're buying just the shares, whether you're trading options and using a spread or just a straight call or put, you should do very well as long as you're on the right side of the market. And that's what these moving averages will do for you. The other thing you can do, last thing I'll talk about, is hedging your position or your overall portfolio. And you can do that in a number of ways, but here's just a couple of ideas, right? If you're going long, say this is Crocs. So, let's say you buy that deep in the money call, right? And you want to hedge it, you can short a handful of shares, right? So again, you want to consider the delta, right? If you're buying one contract here of a deep in the money call, it's the equivalent of 100 shares, right? So if you want to hedge it and say you want a 20% hedge, well, you short 20 shares, right? That's how you do it. It depends on your risk tolerance again. And if you want to hedge your portfolio overall, then say, if you're long on most positions in your account and you want to hedge yourself against a drop in the market, you buy some puts on the SPYs or the Qs, right? The S&P 500 or the NASDAQ, etc. And you look at your overall exposure and you think of a percentage amount that you want to hedge yourself, and that's the number that you buy. We'll go through that, I'm sure, in other videos in the future. But for now, as far as trading in 2023, remember the simple strategy here. Put on a 20-period moving average. If price moves above, all right, and the 20 sloping, feel free to go long. You want to tighten it up a little, make it even safer. Throw in a 5 EMA, throw in an 8 EMA, make sure that all three are sloping, make sure the price is above all three, and make sure that they are stacked in the right order. 5 above 8, 8 above 20. That is your key. And vice versa for going short. You want to make sure slope is lower on all three. You want to make sure price is below all three. And you want to make sure that they're stacked in the right order. In other words, 5 below 8, 8 below 20. And that is the strongest area for you, the area with the biggest odds of success for yourself. Okay? If you'd like more information, somewhere along on this page, there will be a link to click, or it'll be in the email that you received with this. Any questions at all, you can email us at info@tradingwins.com. That's wins, W-I-N-S, tradingwins.com. Thank you again for watching, and we'll see you in the next video. Take care.